Hello, good evening, all.
Good evening, sir.
Yeah, thank you. That means you can hear me.
Yes, sir, we can hear you.
Yes, sir, we can hear you.
All right, sorry for keeping you holding. Now let's go to the business. Please, let's mute our speaker. Ensure your speaker is muted. Ibrahim, please mute your speaker. All right, we are looking at the next topic. Valuation of bonds. Bond valuation and analysis. This topic is price of shares. At the stock market, financial analysts try to determine the price of companies' equity shares. At the stock market, financial analysts try to determine the value of a company shares. The same way we also try to determine value of a bond. The value of a bond, the price at which you can buy a bond or you can sell a bond. A bond is an instrument, a debt instrument that is tradable. A bond is a financial instrument that is marketable. Because this instrument is marketable, then we should be able to determine the price. This price is not static. It can change. Just as the price of shares, the price of company shares is not static. If you look at the stock market reports, share price may rise, share price may fall, or the share price may remain constant. The same thing applies to bond. A bond, a financial instrument that company uses to borrow money. A bond is a financial instrument that company uses to borrow money. We can define bond as a debt instrument that requires the borrower to repay the amounts borrowed plus the interest elements to the lender. You can define bond as a debt instrument that requires the issuer. The issuer is the borrower. That requires the borrower to repay the amounts borrowed plus the interest elements to the lender over agreed specified period. If you look at that definition, there are two parties to bond contracts. There are two parties to bond contracts. A bond is a contract between the borrower and the lender. A bond establishes a legal contract between the borrower and the lender. The parties to bond are the issuer of a bond. The issuer is the borrower. And the lenders. The lenders are the investors. For example, Dangote company can issue bond. Nigerian flour mills can issue bond with an intention to borrow money. If Nigerian flour mills issues bond, the issuer is the borrower. The company is trying to issue bond for the purpose of borrowing money from the investor. Anybody can buy this bond. Individuals can buy. Corporate company can buy. Whoever buy the bonds are called the investors. They are the lenders. From the perspective of the borrower, from the borrower's perspective, a bond is a liability. The interest payable on the bond is an expense. I will take that again. From the borrower's perspective, From the issuer's perspective, a bond is a liability. And the interest payable is an expense. From the perspective of the lenders, from the perspective of the lenders, that is the investors, a bond is an investment asset. And the interest receivable is an income. So please note, if you are asked to explain bond, you can look at it from the perspective of the borrower. You can also explain from the viewpoint of the investors. All right? We have explained bond. Terms and terminologies associated with bond. 1, the face value. The face value of a bond is the amount stated on the face of the bond instrument. The face value of a bond is the amount stated on the face of the bond instrument. The face value is usually 100 naira. Usually 100 or 1,000. The face value of a bond, the amount written on the face of the bond, is usually 100 naira or 1,000 naira. Face value will not change. Just like picking your 1,000 naira notes or picking your 100 naira notes, the amount written on it is 100 naira. That is the face value of the bond. It's also called the nominal value. The nominal value of a bond is either 100 or 1,000. Please note, where the examiner is silent about the face value of a bond, where the examiner is silent about the face value of a bond, you can either assume 100 naira or you can assume 1,000 naira. Next, coupon rates. Coupon rate is the annual interest rate stated on the face of the bond. That is the interest rate stated on the bond. The coupon rate may be fixed. Fixed coupon rate bond. That is, the interest payable annually is fixed. It may be 10% or 5%. That means every year, the interest payable on the bond is 10% until maturity. So you can have a fixed coupon bond. We also have floating rate bond. A bond which interest rate fluctuates. The annual interest rate fluctuates with changes in the general market interest rate. Your floating rate bond. Please mute your speaker. Taiwo Alimi.
Taiwo, please mute your mic. Taiwo Alimi, please mute your mic now.
Taiwo Alimi, please can you mute? That is the risk we have to face. You are lecturing. At the other end, you don't know what the student is doing. All right, please, whatever you are doing in your private house, that's your private house. Just help us mute your speaker. Floating rate bond. Bond with interest rate fluctuating in line with the market interest rate. The interest rate paid in year 1 may be different from the interest rate paid in year 2. The interest rate paid in year 2, in year 3, the rate is not fixed. The rate is not fixed. The rate will continue to change in line with changing. All right. We also have zero coupon bond. These are bonds that do not pay any interest during their entire life. These bonds are issued at a discount. But we mature at their face value. Zero coupon bond. These are bonds that do not pay any interest during their entire life. Zero coupon bonds are issued at a discount to the face value, but we mature at their face value. The return on such bond is called capital appreciation or capital gain, which is the differences between the issue price and the face value at maturity. So zero coupon bond, although it's not very common, where a company will issue bond with zero interest, the company will not pay you any interest if you invest in that bond. But the bond will be issued at a discount to you. At maturity, the bond will be redeemed at the face value. The face value is 100 naira. The discount price is below 100 naira. The difference between face value at maturity and the discounted price and the discounted issue price represent return to the investor. All right. We have premium bond. We have discount bond. We have par bond. Your premium bond, a bond having a market value greater than its face value, where the market value of a bond or the market price of a bond is greater than the face value. That bond is called a premium bond. For example, if the market price is 105, if the market price of a bond is 105, we know the face value to be 100. 105 is greater than 100. In that case, that bond is a premium bond. Discount bond, opposite of premium. A bond having the market value less than the face value. For example, if the market price of the bond is 92 naira, we know the face value to be 100 naira. 92 naira is lower. in that case, that bond is a discount bond. Par bond. All right. Let's continue with the class. It was a temporary network glitch, but we are back. All right. We have okay. I said, please note. Oluwatosi, please mute your speaker. Please note, a bond may be issued at a premium or at a discount or at par. A bond may be issued at a premium or issued at a discount. A bond may be redeemed at a premium or redeemed at a discount or redeemed at par value. Where the examiner is silent about the redemption value of a bond at maturity. Where the examiner is silent about the redemption value of a bond at maturity. You are going to assume that that bond will be redeemed at par. You are going to assume that the bond will be redeemed at par value. All right. Valuation of bond. How can we value bond? How can we determine the price of a bond? We start with one. redeemable bond. How can we calculate price of a redeemable bond? So the question is, what is redeemable bond? Redeemable bond, a bond with a specific maturity date. Redeemable bond, a bond with a specific maturity period. It can be 4 years or 5 years. Examiner will tell you the maturity date. A bond with a specific repayment period. The examiner will tell you when the bond will mature. Once you are given a specific date, that becomes a redeemable bond. The price of a redeemable bond is, we are going to note this. Virtually everything I'm saying has impact on calculation. The price of a redeemable bond is calculated as the present value of the expected future cash flows associated with such bond. The price of a redeemable bond is calculated as the present value of the expected future cash flows associated with such bond. The expected cash flows include: 1, annual interest from year 1 to maturity. The annual interest from year 1 to maturity. That is cash flow 1. That's 2. Redemption value of the bond at maturity. Non-par value. It should be redemption value of the bond. Redemption value of the bond at maturity. These cash flows are discounted to their present value using the bond yield. These cash flows are discounted to their present value using the bond yield. All right. That is how to calculate price of a redeemable bond. Zero bond. The price of zero coupon bond is calculated as wow. Class, the network is a bit unstable. So we said price of zero coupon bond, if you are to calculate it, although it's not very common, just pick the face value, divide it by 1 plus y raised to power n. Your letter P represents price of a zero coupon bond. Letter F, face value of the bond. The face value is 100 naira. Letter Y, yield to maturity. Letter N, life of the bond, that is maturity period. It may be 1 year or 2 years or 3 years. Examiner will tell you the maturity date. Next, convertible bond. What is convertible bond? How can we calculate price of convertible bond? Convertible bond. These are debt instruments that gives the debt holders the right to convert the debt to equity shares. Convertible bond. These are debt instruments that give the debt holder the right, but not the obligation, to convert the debt instruments into equity. The bond holder are giving conversion of the bond holders, the bond investors are giving conversion options within a period of time. You can convert your debt instruments to equity shares. Once the debt holders dies, the bond will be converted to equity. In that case, interest payment will stop. Principal repayment will stop. As soon as a bondholder exercises his right of conversion, the company will stop paying interest. And the principal repayment will also stop. How can we calculate price of a convertible bond? The price of a convertible bond can be calculated either as a straight bond without the option to convert. Please listen to this very well. The price of a convertible bond can be calculated either as a straight debt, a straight bond, without the option to convert to equity, or the option to convert is exercised and the conversion value calculated. There are two methods. There are two alternatives methods of calculating price of convertible bond. There are two alternative methods of calculating price of a convertible bond. Alternative one, valuation as a straight bond. Valuation as a straight bond. In that case, we are going to assume that the convertible bond will now be converted to equity shares. We now value the bond as a straight bond, an unconvertible bond. In that case, the price of the convertible bond will be calculated as present value of the expected future cash flows from the convertible bond. Present value of the expected future cash flows from the convertible bond. These cash flows include annual interest payable from year 1 to maturity, and redemption value of the bond at maturity. These cash flows will be discounted to their present value. These cash flows will be discounted to their present value using, please look at the screen, using required return on an ordinary debt of the same risk class. Our discount rate is the required return on ordinary debt of the same risk class. That is valuation 1, alternative 1. Alternative 2, the price of a convertible bond will be calculated as the present value of future interest payments up to the time the bonds are converted to equity shares. The present value of future interest payments up to that time the bonds can be converted into equity shares, plus the present value of the expected market value of the shares. The present value of the expected market value of the shares into which the bond can be converted to. We got to explain this. We got to explain this. If you are to calculate value of a convertible bond, you can use alternative 1, valuation as a straight debt, or you can use alternative 2, the conversion value approach. If you are using alternative 2, you are going to calculate value of the convertible bond as the present value of future interest payments up to that time, up to the time the bond can be converted into equity shares, plus the present value of the expected market value of the shares into which the bond can be converted to. The conversion value can be calculated as the conversion value can be calculated as, look at the formula below. The conversion value can be calculated with the formula here. Conversion value in year N is equal to PO bracket 1 plus G, close your bracket, raised to power N, multiplied by R, where CBN, conversion value in year N, your PO, current share price, your G, annual growth rate in share price, your letter N, number of years the holder can exercise conversion, your capital letter R, your conversion ratio, number of ordinary shares a bond can be converted to. Now, when you now have the two methods, you have alternative one. You have alternative two. You can value as a straight debt. Now look at this clause. The market value of a convertible bond is the higher of alternative one or alternative two. The market value of a convertible bond is the higher of valuation as a straight debt or valuation of the convertible value. Whichever one that is higher will represent value of your convertible bond. All right. So please note, examiner can ask you to value redeemable bond. Examiner can also ask you to value convertible bond. The examiner can also ask you to value irredeemable bond. You may be asked to value irredeemable bond, a bond without a maturity period. You may be asked to value valuation of irredeemable. Irredeemable bond. Bond. What is an irredeemable bond? A bond without a specific maturity period. A bond without a specific repayment period. If you are to calculate price of an irredeemable bond, this is calculated as annual interest divided by yield to maturity. It's very straightforward. So examiner hardly text it. When we say irredeemable bond, the interest will be paid forever. Annually, company will pay interest from year 1 to perpetuity. The principal amount of the loan will not be repaid. In that case, you are going to calculate price of an irredeemable bond as the present value of a cash flow to perpetuity. In that case, you are going to calculate price of value of an irredeemable bond as the present value of the interest cash flow to perpetuity or to infinity. How do we calculate present value of a cash flow to infinity? You pick the cash flow. The cash flow is the annual interest. Annual interest cash flow divided by the yield. Your yield is the discount rate. All right. So please note, you may be asked to value redeemable bond, convertible bond, or irredeemable bond. Our next discussion, yield measure. Yield. When we say yield, that is the return on bond investment. The yield is a measure of return that the investor receives by investing in the bond. The yield is a measure of the return that the investor receives by investing their money in bond. In the bond market, investment decision is typically made on the basis of the bond yield rather than its price. In the bond market, investment decision is typically made on the basis of the bond yield, bond return, rather than the bond price. A bond yield affects the prices at which it trades. The bond we trade. The bond yield serves as an important measure of potential or expected return. There are three types of bond yield. There are three types of bond yield. One, nominal yield. The nominal yield is the coupon rate of the bond. The nominal yield is the coupon rate of the bond. Number two, current yield. The current yield relates annual coupon interest to the market price of the bond. The current yield relates the annual coupon interest to the market price of a bond. It is calculated as annual coupon interest divided by the market price of a bond multiplied by 100. Is calculated in percentage. That is the current return, the current yield. The current income from the bond as a the current yield measures the current income from the bond price. This information is important to invested in current income. Investors that want current income on their investment. The current yield is of limited use, is of little use because it does not consider the capital gain or loss that a bondholder will realize if the bond is purchased at a discount or at a premium. The current yield is of little use because it does not consider the capital gain or loss that a bondholder will realize if the bond is purchased at a discount or purchased at a premium. And held to maturity. Also, the current yield does not consider time value of money. It ignores the time value of money. Oh, number 3, yield to maturity, also known as gross redemption yield. The yield to maturity is also known as gross redemption yield. This is the most widely used bond yield measure. The yield to maturity considers interest income, capital gain or loss, as well as the time value of cash flow. The yield to maturity consider the interest, the current interest income, the capital gain or loss, as well as the time value of money. The yield to maturity of a bond, the yield to maturity of a bond is the internal rate of return of the cash flows associated with that bond. The yield to maturity of a bond is the internal rate of return of the cash flows associated with that bond. It is calculated by trial and errors. The same way we calculate internal rate of return. The assumption of yield to maturity. The assumptions of yield to maturity. 1. Assumption 1. All coupon. When we say coupon, it means interest. All coupon cash flow can be reinvested at the rate of the YTM. All coupon interest can be reinvested at the rate of the YTM, the rate of yield to maturity. This reinvestment assumption implies a flat yield curve. Number 2 assumption. The bond is held to maturity. The bond is held to maturity, meaning that the investor will not sell the bond prior to maturity. You are going to hold the bond until the bond matures. That is the assumption with the calculation of YTM. Number 3 assumption. All coupons are received prompt and in timely fashion. The coupon interest will be received promptly and in timely fashion. All right. Let us digress a bit. Examiner has tested this question twice. The examiner says, calculate the yield to maturity of this bond. Calculate the yield to maturity of the bond. And explain why the investor may not realize the calculated yield to maturity. Just 1 minute, please. Rabiat, please, a minute. You are asked to calculate YTM and explain why investor may not realize the calculated YTM. Okay, let me hear Rabiat.
Good evening, sir.
Yeah.
Sir, please, the number 1 assumption, can you please explain it? I'm trying to understand what you mean by the investments assumption implies a flat yield curve.
All right. Back to that question. I will now answer Rabia's question. The investor will not realize the calculated YTM if 1, all coupons cannot be reinvested at the rate of the YTM. In that case, this reinvestment assumption implies a flat curve, a flat yield curve, meaning that if your YTM is 5%, if you are going to reinvest, your interest cash flow, you must reinvest at 5% year 1. You must reinvest at 5% year 2. You must reinvest at 5% year 3. That means your reinvestment rate is the same. 5%, 5%, 5%, year 1 to year 3. That becomes flat. You reinvest your money. When you invest in bond, you get return in year 1. You also reinvest the return. When you reinvest the return, you must reinvest at the rate of YTM. That means if you are reinvesting at the rate of the YTM, your reinvestment rate is the same. That is flat. So, if the investor cannot reinvest the coupon interest received at the rate of the YTM, then the investor will not realize the calculated YTM. If the bond is not hedged till maturity, that is, if the investor decides to sell the bond prior to maturity, in that case, the investor may not realize the calculated YTM. If the coupons are not received promptly, as at when due, in that case, investor may not realize the calculated YTM. Rabiat, I hope you are fine now.
Yes, sir. Thank you very much.
All right, please allow me 1 minute. I'll be back. All right, let's continue with the class. Our next discussion, bond duration. Duration of a bond. Duration is the measure of the average life of a bond. Duration is the measure of the average life of a bond. It measures the sensitivity of a bond price. Duration measures the sensitivity of a bond value or a bond price to changes in interest rates. The higher the sensitivity, the higher the duration, the higher the risk. We said duration. It measures the extent to which bond value is sensitive to changes in interest rates. It measures the extent or the degree to which bond value or bond price, please note, you can call it price. Your price is your value. Technically, a digression, please. Technically, if company pays you 500,000, it's assumed that 500,000 is your value. That is your price. So the price of a bond represents the value of the bond. So duration measures the sensitivity of a bond price, to changes in interest rates. The higher the sensitivity, the higher the duration, the higher the risk. Duration is extremely important. An important concept to bond portfolio management. widely used by analysts in the bond markets. The concept of duration is widely used by analysts in the bond market. It measures how long an investor will wait. Or let me put it this way. Duration measures how long it will take an investor to recover the amount invested in the bond. Your duration shows how long an investor in bond will wait before he can recover the amount invested in the bond. Just like your payback period. To calculate duration, you have like 3 steps. Step to be taken when you are required to calculate duration. Step 1, calculate the YTM of the bond. If you are not giving the YTM, calculate the bond yield to maturity. Step 2, use the calculated YTM to discount the cash flows from the bond. Then step 3, use the notation. Look at the notation. And pick my pen first. The notation is equal to summation present value multiplied by n divided by summation of present value. Please, can you mute Ibrahim? Unless you have question to ask. So you can calculate your duration. Duration tells us that how long duration will tell the investor, how long will it take me to recover the amount I've invested in the bond? Just like your payback period. significance of duration. The duration of a bond is an indication of the price sensitivity of the bond to a change in interest rates. The duration of a bond is an indication of the price sensitivity of the bond to a change in market yield or market interest rates on that bond. It shows impact of fluctuation in interest rates on bond price. Duration can be used. The bond duration can be used to monitor the risk profile. The risk profile of a bond investment portfolio. You can use duration to monitor the risk profile of a bond investment portfolio. Investors in the bond can therefore manage the risk in their bond investment portfolio. Investors in bond can therefore manage the risk in their bond portfolio by selecting bond with suitable durations. Duration allows bond with different coupon rates and different maturity period to be compared for investment selection. That's enough. We can use duration to estimate price change in response to changes in interest rates. Modify duration. Modify duration is closely related to duration. It is calculated as duration divided by 1 plus y, 1 plus the YTM. Modified duration is used to estimate approximate change in the price of a bond where there's a small change in yield. credit risk, credit spread. We are almost done with the explanation. Credit risk. What is credit risk? The risk that when a company borrow money to bond to borrow money, that company may fail to pay the interest and the principal repayment as at when due. When we say credit risk, is the risk that the investor may not realize the return. The return as promised by the issuer, the borrower. A company issues bond to borrow money with a promise to pay interest annually and principal repayments at future dates. That company may default payments. Credit risk is peculiar to corporate bond. Credit risk is peculiar to companies' bond. Government bond is assumed to be risk-free. Let me explain that again. Credit risk is peculiar to corporate bond. When a corporate company issue bond with a promise to pay you interest and principal repayments, that company can default. Government bonds are assumed to be risk-free. In that case, the interest yield on corporate bond is higher than the interest yield on government bond. Credit risk. The interest yield on corporate bond is higher than the interest yield on government bond. The higher yield is to compensate investors in corporate bond because the corporate bond is not risk-free. Credit spread. Credit spread is the additional return of premium required by investors in corporate bond. Credit spread. The additional return or the premium required by investors in corporate bond to compensate them for the credit risk of the corporate bond. If I invest my money in corporate bond, such as Dangote bond or Flour Maize bond, Nigerian Bottling Company's bond, I'm going to expect additional return to compensate me. Credit risk associated with corporate bonds. This credit spread is usually stated in basis points. Your credit spread is usually stated in basis points. To convert basis point to percentage, you are going to divide the basis points by 100. The yield on corporate bond, please note this. The yield on corporate bond is equal to yield on equivalent government bond plus relevant credit spread. When you get to your material, note this very well. Yield curve. Let me summarize this. Your yield curve shows relationship between interest payable and the maturity period. Let me summarize this for you. The yield curve shows relationship between the length of borrowing and the interest rate payable. Usually, the longer the maturity, the higher the interest rates. Obioku, please, can you mute? Thank you. So the yield curve shows relationship between the length of borrowing and the interest rates. Government spot yield, okay. Let me explain that. We have government spot yield curve. We have government spot yield curve. The government spot yield curve shows relationship between interest rate payable on government bonds and the maturity period of the government bond. One minute. Let's continue with the class. We said government spot yield curve. Government spot yield curve. This shows relationship between interest rates payable on government bond, the maturity period of the government bond. Note, government spot yield curve can only be used to value government bond. Note, government spot yield curve can only be used to value government bond. If you are required to value a corporate bond and you are giving government spot yield curve, in that case, you are going to pick that government spot yield curve and add to it the credit spread of a corporate company. You are going to pick the government spot yield curve, then add to it relevant credit spread so as to obtain corporate company yield curve. If I'm to value a corporate company bond, I'm going to use corporate company. If I'm to value government bond, I'm going to use government spot yield curve. And please note, when value bond, we don't consider taxation. When you are required to value bond, you are going to ignore taxation. All right. Estimating Okay, bond valuation using the yield curve. You can value bond using your yield curve. I've explained. If you are to value government bond, you are going to use government spot yield curve. Let me put it here. Let me put it here, please. To value government bond, use government spot yield curve. To value corporate bond. Use government spot yield curve plus relevant credit spread. Please, when we get to calculation, you are going to see this very well. You can write this down somewhere. Every calculation is based on principle. Without understanding the principle, then you are just doing guesswork. Any calculation and applying the principle, that is a guesswork. Just 1 minute. I'm trying to take water. All right. Was a temporary. Now, at times, the examiner will give you the government spot yield curve. For some questions, examiner will give you the government spot yield curve. Why some question, examiner will not give you the government spot yield curve. where you are not giving, then you are going to estimate government spot yield curve. Look at it here. A yield curve may or may not be provided by the examiner where they are not giving. The next issue is to consider how this can be constructed. The technique is called boost yield curve. 3. We shall bootstrap. To round up this class tonight, credit ratings directly. Companies are rated double A's. Some are rated single A's. Some companies are rated B or C or D. What is the impact of credit rating? Credit rating defines the capacity of a company to obtain borrowing and pay. The credit rating shows the ability of a company to meet its financial obligations as at when due. Just as companies are rated, individuals are also rated. The ability to meet your financial obligations as at it becomes due defines your credit rating. If you are able to meet your financial obligation as they become due, that would define your credit rating. If a company is rated triple A's, that shows that that company can undertake any borrowing and repay the amount. That company has that capacity. That company has the trust to borrow any amount and to repay the amount as they become due. The credit rating is done by rating agencies. And they consider different factors so as to determine the credit rating of a company. Your credit rating will have impact on your cost of borrowing. What are the factors? that influence credit rating. Number one, size of the firm. One, size of the firm. Bigger firms, multinational firms enjoy high credit rating. Number two, level of financial gearing. When a company is highly geared, or when the financial gearing is high, that can reduce the company's credit rating. Number three, the risk characteristic of the industry. Risk characteristic of your industry, where a company operates. For example, the banking sector industry. The banking sector, that industry is highly volatile. Number four, the credit characteristic of the country, or the risk characteristic of the country. Of course, companies operate within a country. Where that country is highly volatile. That can affect the company's rating. Five, standing of the company compared to others in the same industry. Like saying Zenith Bank within the banking sector. What is the standing of Zenith Bank within the banking sector? Number six, perceived strengths of the management. That is the quality of the management team, the integrity of the management team, the competency of the management team. All this will have impact on the company's credit rating. Oh, asset backing of the company. Then cash generating ability. These are the factors that influence credit rating. All right. We are done with the explanation. Any question?
No, sir.
We got to go. Please, when you get the video, or find a way around this, try to imbibe the principle. We shall stop here. May God give us a better understanding.
Amen.
Amen. We need it.
Please, let's get some. Let's have a good night. But please, don't wait. The exam is coming fast. Start to read whatever you can read. No matter how little it is. Every day you must invest in your exam. All right, good night.